Africa, we greatly value the strong cooperation between our two countries across energy, maritime affairs, fisheries, climate, governance, and business development. Ghana has consistently demonstrated leadership in regional dialogue, democratic governance, and energy sector development. At the same time, the challenges are significant. Africa's population is growing rapidly, energy demand is increasing, industrialization requires reliable and affordable power. Climate considerations are reshaping investment decisions globally, and public finances across many countries remain under pressure. This means that mobilizing private capital will be absolutely crucial. International public funding alone will never be enough to finance Africa's infrastructure ambitions. The key questions, therefore, becomes how do we reduce risks sufficiently to unlock much larger flows of commercial investments? In Norway, we increasingly believe the answer lies in partnerships that combine public institutions, development finance, private investors, and local ownership. We see promising examples already emerging across Africa. Blended finance structures, guarantees and risk-sharing mechanisms, regional power market integration, and stronger collaboration between governments and institutional investors. Norwegian institutions such as Norfund, the Norwegian Investment Fund, and Norwegian private sector actors are actively exploring how to support sustainable infrastructure and energy investments across the continent. Not because this is charity, but because we believe long-term African growth represents one of the most important investments and partnership opportunities of the 21st century. We also believe strongly that the energy transition in Africa must reflect African realities. There is no one-size-fits-all pathways. Countries must balance energy access, affordability, industrial growth, and climate commitments in ways that are practical and inclusive. A just transition must also be a realistic transition. And this is particularly relevant in the discussions around gas infrastructure, transmission systems, and regional interconnectivity. In many cases, these investments can play a critical role in improving energy reliability, supporting industrialization, and enabling future renewable expansion. Excellencies, ladies and gentlemen, one of the strongest impressions I have from working in Ghana is the level of talent, entrepreneurship, and ambition that exists across both public and private sectors. The challenge is there's not a lack of ideas, often it is how to structure partnerships and financing models that can turn ideas into scalable projects. Forums such as this conference are therefore extremely valuable. They create trust, they connect institutions, and they help bridge the gap between policy ambition and investment reality. Norway stands ready to continue working with Ghana, with African partners, and with the wider international community to support sustainable, commercially viable, and inclusive energy development. Because ultimately, we are more connected. A more connected Africa is not only good for Africa, it is good for global stability, global growth, and our shared future. Thank you very much.
That was Her Excellency Sylvia Vev Atne, who is the Counselor of the Norwegian Embassy in Ghana. Ladies and gentlemen, we'll be moving on now to our second plenary session. But just before that, I want to make an announcement that all the panelists and VIPs who come on our plenary sessions, you are to move to the Prime Vera Lounge after each session. So you just make your way to the Prime Vera Lounge after each session. If you need directions there, our ushers will help you find the location. So what's next for us in plenary 2? We are talking financing the corridor, capital infrastructure for cross-border infrastructure. And the point here, really, or should I say the news, the central thrust of what we are trying to get from this plenary session is that building a connected Africa requires capital that knows no borders and meets the financing needs of the continent's physical, of the continent. Therefore, we are moving from physical bridges now to more efficient ways of collaborating with each other. This session will feature the following people. It will first be moderated by Asia Nete, Senior Associate at Temples, And the speakers that she will be leading in this plenary session are Dr. Theophilus Champon, Technical Advisor, Ministry for Finance, Ghana, Mr. Zachariah Do, Managing Director, Africa Energy Investment Corporation, Robert Laye, Managing Partner of RMC Management Consultants, Alice Osei Okra, Partner, Strategy and Transactions, Isaac Simpson, Head of Financial Advisory and Equity Capital Markets at Stabmeck Bank, and then also Professor Ferdinand Ahiako, Deputy Managing Director, I beg your pardon, of Agricultural Bank. So ladies and gentlemen, this is the high-powered delegation that will be doing the deliberations. Please put your hands together for them as we hand over to the moderator. Yes, please come up the podium, please come up to the stage. And as I said again, they will be taking us through financing the corridor, capital structures for cross-border infrastructure. Africa Energy Finance and Investment is partnering with the Africa Energy Technology Center for this particular session. Yes. Okay. So, my dear moderator, your panel, and then you handle the audience. I would advise that you sit to the side. Yes, the far end. Okay, so over to you. Our technical team, please, can you ensure that the microphones are live?
Hello.
And I believe we need more than just one microphone here so that the rest of the panelists also can make their contributions. Our moderator needs a live microphone now, so please ensure that she gets one. And again, I'd like to entreat our VIPs that after the plenary session, you make your way to the Prime Vera Lounge to be taken care of. And if you're looking for that location, you can speak to any of our ushers, and they'll be happy to lead you there. Do we have a microphone now? So I'll take advantage of this, this moment to give you what the background to this concept is. We shift from general project finance to corridor finance. This forum explains how to structure bankable deals of multi-country pipelines and transmission lines, mitigating the risk of projects that span multiple jurisdictions. It's a mouthful for me, but I believe our panel will do the justice to this issue. So over to you, Madam Moderator.
It's yours working, so we can pass. Oops, sorry.
Good afternoon, everyone, and welcome to the second plenary. Our topic is financing the corridor, capital structures for cross-border infrastructure. This topic is very timely and important on this issue because Africa
take mine. I'm Alice Osei Okra. I'm a strategy and transactions partner with EY Ghana. EY Ghana is a member firm of the global EY firm with about 400,000 employees across 150 countries. We assist clients with assurance, that's audit work, business and technology consulting, tax advisory, strategy, and transactions. It's a pleasure to be here to join the discussion. Thank you.
So I'm Isaac Simpson. I'm an investment banker with Stanbic Bank, which is a member of the Standard Bank Group.
Thank you for the introduction. So we're going to dive right in. And I think my first question is going to from your perspective, what is the single biggest financing variance for solar energy technology construction?
Right, I'll start by maybe reframing the context a bit. Usually people talk about the fact that there isn't capital to finance projects in Africa. But I look at it more from a preparation perspective. If you look at the history, less than 10% of African financing projects or African infrastructure projects get financed. Right? That is a very low number in terms of how much of those deals actually get presented to the deals. Well, that means that if your preparation is weak, right, what happens is that the investors or those who want to finance these projects, right, they don't have the confidence that really to support the financing frameworks that you are looking for. If you look at why that happens, right, I believe that a lot of it has to do with lack of proper due diligence or feasibility frameworks that exist to really underwrite the risks that underpin the projects that we have, right? You see a lot of these revenue models that I've seen across a number of these projects that are being tabled, and they are not really defensible, right? Also, you look at the legal and concession frameworks across these cross-border projects, right? And you realize that there's not a lot of due diligence or stress testing of these assumptions. And when you multiply this across multiple countries or which this asset is supposed to touch, the risk multiplies enormously. Thirdly, I think that there is also not a very clear risk allocation framework between the host countries, the financing partners, and also the government, the sponsoring government, right? When I look at the Middle East where I'm based, right, a lot of projects that get financed do not get financed as a result just because they are wealthy nations, right? No projects get financed without proper due diligence and very technical commercial feasibility that is done. So these frameworks support every assumption. Before the PIF or the Gulf sovereign nations write a single check or a finance draft letter, right? There are years of studies. There are different assumptions that support this, right? And I believe that with the right preparation, if you have the right preparation and you bring forward the transaction advisors to really underwrite the risk of these projects, then you can be able to really provide the context that needs, and you have the various assumptions that support, and that gives investing partners the confidence to underwrite and to invest in these projects. when you look at also most African projects that have been financed, when I've been at tables and having discussions and conversations, the transaction side seems to be limited in terms of budget. The preparations for it is like, let's try and limit it, and then let's finance more of let's look quickly to get to the capital stage. Let's finance it. And I know there are a few bankers on stage, so I'm not going at them. But my view is that get in the transaction advisors first before you get to the bankers, right? No offense to the bankers. But I believe that when those risks are properly underwritten, and then you bring the bankers to the table, then there's more confidence. Or when you bring in the financing partners, there's more confidence for them to underwrite the projects. And then we can get that 10% number to a very high and appreciable number. Thank you.
Thanks, Robert. I mean, that's quite interesting. The point about early structuring is really important, because that sets the stage really and provides whether the model is actually workable, implementable, and whether or not bringing in that finance would actually be implementable. So that gets me to ask Alice this question actually. What financing structures would you say are most viable for large-scale corridor projects like we are trying to do right now in Africa? And what do you think would need to change to make these project pipelines, I'll say, more viable or investable?
All right, thank you so much for the question. I think most of this corridor transaction, I think the first speaker indicated feasibility studies, or really having a robust model that will help identify the risk. So if you bring in, so when you mentioned transaction advisors, I smiled, because that's what we do, helping promoters, countries, putting bankable projects that will attract funding. So having a feasibility study, the technical studies, identifying the risk at very early stages, putting in mitigating strategies to make it attractive. Even the funding structure, what are we using? Are we using our typical debt? I think a lot have gone on in terms of blended finance, because one model will not be enough. You cannot just do equity. So you do equity, even equity, there's some quasi-equity instruments involved, a bit of convertibility in there. You're doing your pure debt. You're also doing your mezzanine financing. You're doing developmental finance with concessionary rates. You also have grants in there. So once you have that hybrid approach, it makes it easier to transaction close. And also engaging stakeholders early. I think in the minister's speech, Minister of Energy and Green Transition, he made mention of the fact that the West Africa Power Pool, he met with Benin, some of the key stakeholders. So involving some of these key stakeholders at the onset, before you even go to market to raise capital, to know their needs. How are they growing? How are the demand going to scale over time? So you do all that at the preparatory stage, before you even bring the banks in to establish the bankability, the feasibility. You've built in all the risk model, revenue streams, very clear. Assumptions are tested, sensitivities run. As we do that, we'll be in a better position to raise financial funds and make the transaction very successful.
I mean, I think that's a very useful point that you've made, especially because the conversation on African infrastructure has historically relied a lot on international capital. So it's important that before the model is even determined, we are sure that it's bankable, because then when the banks come in, they are looking at close and all of that. But what if the finance is mobilized, and then at the practicability stage or implementable stage, we realize it's not meeting the goals of the model? So then I think for me that brings me to Isaac, because there we are now at the, should I say, the finance mobilization stage, and that is where people like Isaac do their best work. For me, my question is, when we speak about most of the issues, bankability and repayment discipline become sort of some of the risk factors that the banks may be looking at. Especially in terms of cross-border projects, currency as well as revenue risk is always part of the risk allocations that we consider. So how can, especially cross-border in our various jurisdictions with different political risk, different currency risk, revenue risk, how can currency and repayment risk, how can we manage these where revenues, costs, and debt service may sit across different countries or currencies? How do we effectively manage them such that we can fit them into the model and make the projects more investable and bankable?
Okay, thanks for your question. I think I'll take a step back, right? When we are talking about a country financing power projects or financing infrastructure projects, it comes with its own challenges, risks, as well as advantages. When we talk about financing a corridor, right, it's a whole new thing altogether. So the first question you asked, when you think about it critically, the three main things I would say that are a challenge to putting up corridors of power projects, etc., are one, institutions. Do we have strong institutions in Africa? Right? Strong government institutions. If you want to set up a power project, let's say running through Ghana, through Burkina Faso, through Togo, maybe transmission lines, etc., you need to have an institution that encapsulates all these countries together, right? That institution must be backed by the governments of the country. There must be solid treaties backing those institutions, and there must be strong governance, right? People don't need to go off the reservation when stuff happens. So that is very important, having strong institutions. Two, the right partnerships, right? When we talk about even financing projects within a country, you always need the government's institutions, you need the private sector. And the private sector comprises not just of banks, not just of advisory companies, but also comprises of funds, investment funds that would flow into some of these projects. And so the right partnerships is very, very key. The third thing I'll talk about is risk allocation, or you can even say negotiation. Because sometimes when you sit at a table to do a deal, right, investment bankers don't look at just deploying capital or advising on capital. Investment bankers look at where is risk and how is risk allocated. Is it allocated efficiently? And that takes a lot of negotiation, right? So if you say, for example, you want to do a project that spans, let's say, 2 different countries. Let me say Ghana and Togo, right? There are many things that come to the table when it comes to negotiation to do maybe just one financing deal. It could even happen that when you are doing that particular deal, there is something that maybe the government of Togo needs from the government of Ghana that might not even be within the deal, and they can negotiate, and because of that, they can have something done in terms of a deal, right? So in terms of managing risk, that is mainly through our own scientific risk allocation methodologies as well as negotiation, which is very, very important. Because if you don't have these things, you can never do a deal, especially the top 3 things I mentioned.
I mean, from what I'm hearing from you, you are saying that basically governments are really important in de-risking cross-border transactions, because where institutions are not strong enough such that they're able to provide the support that these projects need, then it creates sort of higher risk. And then where there should also be enough or adequate partnerships within the sector, as well as fiscal tools and other, should I say, policy initiatives from government. Where do you think that sort of local investors and regional capital comes in with regard to this kind of?
So how we see it is this. Like back at Standard Bank or Stanbic Bank, what we typically do is this. We have teams that run across the value chain. When I say the value chain, I mean we have sector-specific teams. So if you have a power project, if you have an infrastructure project, even within the power project, is it an infrastructure thing? Is it a transmission thing? Is it a grid solution you're looking at? So you have sector-specific teams, right, that would look at this from a sector lens. Then you have functional teams. So you have folks like the advisory bankers, the M&A bankers, who sits down to try and understand how the capital stack would look like, right? If you take a typical project, you could have, as Alice was saying, you could look at different ways of financing the capital stack. You can definitely have sponsor equity there. You can have ECA-backed bonds or ECA-backed facilities. You can have bank debt, which is commercial, typically which is sort of at the top. And you can have mezzanine finance. But all of this, you need to understand everybody at the table and then see what everybody is bringing, what everybody is afraid of in terms of risk, right? And then allocate that efficiently. There are situations where a DFI or let's say an AFI can say, okay, I'm going to give XYZ amount of debt, but that debt, I want an option to be able to convert to equity because maybe I'm the first mover, right? So there are various mechanisms you can use on the capital structure. Then you have the folks who will just do the debt, like the balance sheet folks in the banks, who would now also look at the bank's position. So the bank also has a book, and the bank is also going to invest depositors' money. So they would also come and look at it. So I can tell my bankers, you know, I think you should bring in XYZ amount. But my bankers can tell me, Isaac, here you are in the bank, but we are not going to do this because we are afraid of XYZ. So you need to allocate that type of risk across everybody on the capital structure to be able to have an efficient capital structure, which just doesn't make you do the deal, but makes the deal viable into the future, right? And so when you even have some mechanisms that allow people to exit during the future of the deal, if you even have concession frameworks, etc., over a number of years, it guarantees your the returns for each investor, right? Because there are some investors who would sit at the top and say, okay, we are providing viability gap funding. You know, we don't hope to get any money back, but if we get any money back, we are fine with it. So there are different types of investors, different return objectives, different risk objectives also.
So basically, commercial capital needs a certain level of preparation and certainty. So depending on where the project sits, then that sort of financing would come through accordingly. So for Mr. Dosa, I would say that the question I have for you is, how can, should I say, blended finance and concessional capital be used to sort of crowd in private investment for corridor projects, okay, without sort of becoming, in a sense, a permanent subsidy? So such that we are, the private capital is coming in, but is not coming in such that it's a permanent subsidy on the project, and we are not always looking to subsidize these projects as they are done. How do you think blended finance can assist with that kind of?
It's good to let the project led by the regional South African regional organization, and they are working on that. They are getting support of some countries, and if they manage to get all the involved countries where the pipeline is supposed to go through, is going to facilitate the money, the funding raising for the project, the regulation matter, all those things. So this is very important. The second thing now, if the regional organizations are involved and the initiator of the project, they can also bring now big financial, like the financial development, financial institutions, since those countries are shareholder of those financial institutions. And I was talking about the Africa Energy Bank, for example. This is a project led by an intergovernmental organization like Afrexim, APO, and APO now working with Afrexim Bank, which is the financial institution, is giving more trust in the project. And our strategy is the seed capital should be provided by those funding institutions, APO, member countries, and Afrexim Bank. We are not looking at this stage equity funding from the Class B and Class C, which are non-APO member country and private sector. So we launched the bank with those two institutions, countries, APO member countries, financial institutions. So when we launch now the bank, the private sector, other investors now will believe, will trust, because we have the confidence, we have launched, and we have the sovereign guarantee. This is very, very important also. So this is the step I can recommend for any developmental project, because sometimes those projects at the initial phase don't look bankable or they don't look profitable project. So if country put at the front the development priority of the population and take the lead of the project, at the end of the day, it's going to be profitable and the private sector is going to come on board.
That's interesting to know. So basically, we need stronger institutions, our DFIs, our sort of state institutions to put the money where their mouth is, and private investment would follow along. And so, Robert, I'll come to you and ask you this. I mean, looking at mobilizing sort of private investment from regional and local investors, what would it take to sort of mobilize these people at scale? Because I think sometimes the problem is that within Africa, there are institutions who could provide the funding, but they are not, one institution or two of them cannot provide the scale or the level of finance that is needed to complete these cross-border financing. But with some doing or some innovation or thinking, we could mobilize them at scale such that we will be able to finance these cross-border infrastructure projects. What do you think it would take?
Thank you for the question. I'd like to sort of piggyback from where he started from to answer the question, right? The thing is, usually when we talk about financing projects, the scale always sort of beats us up, right? And I think President Mahama, His Excellency, I think speaking earlier this year, I think he made a statement about that there's about $2.5 trillion of capital which is locally deployed, which can be mobilized for African development. And I think that it was also alluded to in His Excellency, the Minister of Energy, as he spoke and talked about the gap in terms of having monies in our petroleum fund invested externally, and it's $1 billion, I think he mentioned, right? And it's interesting when we talk about scale, and sometimes we think that we don't have enough capital in Africa to finance our own projects, right? But I'll take it a bit further to say that it's about signaling. It's not about the quantity, right? And I think that's what Zakaria was saying. If you can signal to the international markets or to the foreign capital sort of donors or other big lenders that there is local or regional appetite and local uptake of a project, then you get that interest from these external people. Because imagine if a deal goes to an international player and then he asks, okay, but who is leading this or who is anchoring this project, right? It's a good project on the face of it. The due diligence is done. but then there's no one at the table, and the expectation is that that person should put the significant amount of capital. Where is the Nigerian pension funds? Where are the South African insurers? Where is the Kenyan asset managers at the table to allocate capital? And sometimes it's not about putting the full scale of capital that is needed. It's just the interest and the appetite is what draws in the interest from these other people. Back to where I've been. I've been there for a few, close to 2 decades, right? Almost 2 decades ago, most projects which were financed, infrastructure projects which were financed in most of the Gulf countries, was financed through international partners, right? Fast forward to today, most of the projects are underwritten by regional banks, the sovereign funds, the GCC pension funds, right? But what that means is that when there's that appetite and that uptake locally, now you get the interest of the Black Rocks, you get the interest of the other other hedge funds, everybody coming in to try and take a bit of it, because there is that local interest and appetite at the table. So for me, I believe that we need to get the sequencing right. Is we need to get regional interest, we need to get local appetite invested first. And once we get that right, and I think that by what the work that Zakaria was talking about earlier with the Africa Energy Bank and all of these things, then that means that you can get local interest, or you can get investments coming in, not only from local banks, but also at least at the regional level to finance the scale that we need. And even if we can mobilize 30%, 40% on the continent, then the rest can really be attractive to foreign capital or for other stakeholders to come and participate in this particular initiatives that we're undertaking.
Thank you for that. I mean, it's quite clear we do have the capital on the continent, and it's about putting in the right signals and the right sort of things in place, and we'll be able to mobilize. And that brings me into sort of an area that is growing a lot in recent time in respect of carbon financing. And so, Alice, what do you think, what do you think the role is with regard to green bonds and carbon financing on projects, and what role do you think they can play?
Thanks. I think in Chief of Staff speech, when he read for the president, green financing came in strongly. For such big projects, it's very important you attract some of these funds, climate funding, that rates are concessionary in a way, but it's also very difficult because they also have very stringent, requirements in terms of the impact, the environmental impact. 2 years ago, in 2004, the Ghana Stock Exchange came up with the green bond guidelines. So companies, so government entities, private corporates, municipal authorities can raise funding, by raising green bonds on the Ghana Stock Exchange. I think the minister mentioned the gas projects that they are about to, commission. So some of these projects we can raise funding from the stock exchange. I think he mentioned local funding. In terms of pension funds, I think it's around $8.9 billion available. The NPRA, that's the National Pension Regulatory Authority, have given them, in terms of assets allocation, up to 25%. They can allocate up to 25% in alternative assets, whether they are investing in private equities who would then take up stake in some of these projects. But as at now, it's less than 1% allocation. It all boils down to the fact of the preparation, the risk appetite, and all that. So it would be very good to see some of these things, even on our local markets. Nigeria, huge pension funds, Ghana, huge pension funds, and these ESG funds or green funds require stringent measures. They all have different metrics. The good thing is we now have a synchronized reporting framework. We call it the IFRS S1, S2. I'm sure most of us are aware. General requirements and then climate-focused requirements, that's the S2. Different countries in Africa have roadmaps to comply. Ghana has put up a roadmap. It's being spearheaded by the Institute of Chartered Accountants that come 2027, we are all going to report after preparing your financial statement, you also do your sustainability reporting, looking at your impact, green impact, and all that. So this will make it easy for us to attract some of these funding. And it's being phased, it's phased approach. So we have the SPIs, that's the significant public interest entities, like the banks, insurance companies, upstream exploration. So we have, it's tiered in a phased approach so that when people apply, we know that Ghana or West Africa or the whole of Africa, we are all reporting sustainability through the S1, S2, and it's very easy for such projects to then attract green funding because there are matrices we are tracking, scope 3 emissions, what you are emitting, your greenhouse gases, what your stakeholders in the value chain. So very clear, and we'll be able to assess some of these funding stringent, matrix because we can demonstrate that this is how we are mitigating and we can take advantage and if possible list on the exchange. And these local funds will be able to invest, and then the crowding effect of other developmental finance institutions will also make it feasible for us to do that.
From your perspective, what changes would make these projects pipelines more investable?
So, as I indicated earlier, one, having a bankable or a feasibility study underpinning these projects because it cuts across jurisdiction, the legal and regulatory framework totally aligned because every country has their own laws, language barrier and all that. Having a governance framework like the West Africa Power Pool, having a governance framework where you have stakeholders from all these countries coming in, it makes it easy. Also having a very clear revenue model on how you're going to repay the funding over a period of time because these are long-term funds, 10, 20 years for such major projects, and even sometimes they need to refinance, so having that in place. And to add to the ESG or the Green Fund, also having in place strategies. So when we do some of these feasibility studies or project preparation, we do ESG due diligence as well. So having a due diligence on ESG, having your financial and technical due diligence properly done by a professional firm, as I mentioned, EY and other professional firms, you also work across different jurisdictions. So it's not only in Ghana, in Togo, in Nigeria, you have people with local insights that can contribute to making these projects bankable. And as we do that, we'll be able to see more success rate and see the 10% closure rate go up. Thank you.
Isaac, I was just curious listening to a lot of the things that are saying. I mean, we know that we can raise the money, we know that we can. I'm curious about what financing challenges often arise between the time of, shall I say, concept implementation. So now we have sort of, we see that there's money, but obviously when you are thinking about risk allocation and where the risk sort of usually sits, between the time that we have sort of raised the money or look to assure that we can get the money in at various stages of the project and the time at which the project's actually done, what are some of the real risks that come up? Because these are the things that will be challenging for ensuring that the finance actually comes in.
Okay, so if I get you correctly, you are asking of the risks in terms of financing some of these projects.
Yes.
Yeah, so as I mentioned earlier, there are different types of ways to finance projects like this, right? You can use bank debt, right? I don't want us to limit ourselves to just bank debt. Bank debt is often the most expensive across the capital stack, right? And if things don't go as planned, they are the first in terms of the waterfall to receive payments, right? You can go down further to various types of, you have infrastructure funds, you have sector-specific funds that invest only in power, right? And then these are folks that will say, okay, you know what, we would invest, we will structure it in a certain way, we can do maybe straight debt, we can do a convertible bond, we can do a bond with an option, we can do some sort of a mezzanine instrument, right? based on their own risks that they are looking to mitigate, right? And then their return objectives. So you can have that. You can also have bonds, right? So you can have a situation where the government or the governments or even the institution, the regional institution, raises an infrastructure bond, right? And then that infrastructure bond come and lie, let's say, between bank debts and equity, right? And so infrastructure bonds, one thing I always like to say is that when you're raising infrastructure bonds, you should also have institutions that can guarantee these bonds, because it de-risks it for the pension funds, the local pension funds. We have a lot of local pension fund money trapped in certain asset allocation classes, which will be best served in areas like this, because it's our development in the end, right? And so you can also raise bonds. You can even raise these bonds, securitize these bonds, and then sell them off again to pension funds, like as an asset-backed security, right? For pension funds who want regular income. So when you even do that, what happens is that you recycle the capital. You have fresh capital to put in a different part of the capital structure. You also would have equity. Typically, you would want the government to take an equity position, right? Sometimes you want them to take an equity position and then maybe take a position slightly above equity so that they can begin to see some sort of returns while majority of their capital is in equity. But sometimes too, people might also tell you, investors might tell you that, look, we don't want government to own 100% of this because of maybe past happenings. So why doesn't government own 10%? We will put in 90% of the equity, but majority of the capital will be across debt securities, right? And then sometimes, so when you do some of these things, you have something we call a meager guarantee. You know, you can have guarantees from the World Bank, etc., which most of the governments are afraid of defaulting, because when you default, you cross-default on other securities you have with them or other obligations you have with them. So they typically would stay in line when there's a meager guarantee. So there are various ways you can mitigate this across the capital structure, as well as some guarantees from government, as well as World Bank and other supranational institutions.
And to what extent can, shall I say, capital markets be used to finance some of these cross-border infrastructure projects?
Yeah, so as I even said, one of the key things you can even do is an infrastructure bond, right? If you have an infrastructure bond that is well thought through, and then everybody knows where the proceeds of the capital is going to, and everybody sees that this has been done before, or even if it's not been done before, but there is some seriousness, institutional capital would go for bonds like that. Because, you know, in the past in Ghana, up until now, we've had a situation where you have an inverted yield curve. And this is simply because of the way government will borrow on the short term as opposed to the longer term. So we didn't even get price discovery. So you cannot look on the bond market and get actual price discovery. It's a situation we also have in the stock exchange, right, where you have most of the companies with depressed stock prices, but now there's a re-rating, so it looks like stocks are rising, right? So what you typically would want to see is when you are able to give out 15-year bond, right, with a fixed yield of, let's say, 15%, it helps in making the yield curve, like correcting the yield curve, as well as giving pension funds and people who want to invest, they see a stable coupon coming to them, and this is what they are for. You know, these are pension funds who have long-term capital. So you can actually use the capital markets to raise a bond. You can even use the capital markets to, when you raise a bond, let me give an example, like Socoprim in Cote d'Ivoire. Socoprim in Cote d'Ivoire has equity holders, right? Not just the government. They tried to list, I think in 2023. This can be a way for a liquidity event for even the shareholders who are currently owned. And then you can have the country own it alongside them. So you have various ways. You can raise equity, you can raise debt. And then it's just the way you raise the equity or the debt, and then the use of funds, and then the success of the project into the future. That guarantees some of these. Then lastly, as I mentioned, for the bonds, if you have an institution that can guarantee, like a guarantee or an infra credit school, it's something that would also give the pension funds, it would de-risk for the pension funds to be able to invest freely.
Thanks for that. So, well, just sort of in wrapping up, I would like a perspective from all the panelists. What one change do you think would make cross-border financing infrastructure work better for us? What one change, if you had to pick, would you think we need to make as a continent to make cross-border financing more useful for us in our infrastructure development? Isaac.
So for me, it's two words, no one. Regional cooperation, strong regional cooperation. Yeah, just that.
That tracks with the conversations we've been having this morning.
Yeah.
Zach?
Okay, so I align with him. Regional cooperation among the country and also, as I said, involve regional and continental financial institutions to solve the financing problem.
Thank you.
Okay.
Alice?
Collaboration. You know, as we collaborate, we'll be able to solve our own problem. We'll be able to raise the capital. Because from the various speakers we've listened to, and even using Ghana as example, we see that there's so much pool of capital in. If we collaborate, legal regulatory frameworks are aligned, it will be easy for us to invest in some of these cross-border projects.
Yeah, I think to sum it up, I think it's back to the first point I made around preparations. I believe that the more prepared we are at the table to really articulate the benefits that will accrue to investors, and also to really prepare around the proposals that we are putting forward for funding these things with the elements that they said, I believe that will be really key to ensuring success for financing these projects.
Thank you. I think, there's a strong place to close. What this discussion has shown, at least for me, is that financing corridors is not simply about finding money, basically. It's about making sure that we are preparing our projects properly, we are allocating the risks clearly, we are aligning governments, actually that's quite important, using blended finance intelligently, making sure that would bring other private investors and other people to the table, and creating structures that commercial lenders, development partners, and local investors literally can support. And I think one key takeaway, which is really on point with the entire theme for this, is regional cooperation, collaboration, and just governments making sure that we are aligned in our policies and our aims to ensure that we actually building the future that we need in energy and technology today. So join me in thanking our panelists, and I hope you have learned a lot like I have.
After taking the group photograph, we will go for a lunch break. We'll take a short break, after which we'll come back to continue with the rest of the program. But at this point also, I'd like to encourage all the panelists to move to our lounge. There's a special lounge that is reserved for you. Our ushers will take you there to be accorded some special treatment. Given that time also, I'd like to acknowledge the presence of Dr. Hafiz Adams, who's the Director for Technical Coordination and the Ministry of Health. Ladies and gentlemen, he's representing the Minister of Health. A round of applause for him. And an interesting piece of information about him, he speaks about 9 languages. So ladies and gentlemen, thank you very much to our distinguished panelists. We want to say thank you to you for the knowledge you imparted to us. We'll take a lunch break now, and when we return, we'll continue with the rest of our program.